Today on the Wealth Guide podcast, we're joined by special guest David Boyle from Ascalon Capital. And we're going to be discussing the effect that headlines have on financial markets, what it means to investors and financial decision making. So the things that we're going to be talking about is, what does this mean for Australians in real life? What people should really review and what they shouldn't, when to panic and when not to, and what a financial advisor can support you with. All right, so everyone, welcome to, oh my Lord, Wealth Guide podcast episode, I feel like it's 6,665, but I think the reality is it's episode 67. Very lucky today, guys. We have David Boyle from Ascalon with a wealth of knowledge, perfect guest, and the only guest we could ever have for today's topic. When headlines shake markets and what it means to investors and financial decision makers. Really, really big moments at the moment. So much going on. I can't imagine how busy you are, David.
Well, thanks for having me back here today, Mel and the Riker team. Look, it's always a lot going on in markets, and it feels like there's an especially high amount of headlines hitting us at the moment. Since Trump got re-elected especially, there's frequent changes in policy, and those policy changes and events are having impacts on markets, and they're moving them. One thing that I think everyone needs to keep in mind, though, is that these headlines are often quite sensationalist, especially when it comes to the market. You'll see things come up in the news like, markets meltdown, the markets have crashed, all of these big headlines in red letters. Or one of my favourites is when they talk about, $500 billion has been wiped off the value of US stocks. Now, that all sounds really exciting, but the reality is that a $500 billion move in the US stock market is 1%. That doesn't sound quite as exciting, but it's a reality that there's a lot of noise, there's a lot of ways to try and hook you in, whether it's newspapers or television or social media, but it's not always reflective of the truth about what's happening.
So with this, what would you say that the investors and markets are watching most closely in a period like this?
Specifically for this period, with the conflict in Iran, everyone's watching this key body of water called the Strait of Hormuz. Now, that's a very important part of the global energy trade. In fact, around 20 or 25% of all oil passes through the strait. And not only oil, but natural gas, fertilizer, and would you believe helium as well? Lots of helium goes through there.
Right.
I know what you're thinking. The kids are going to have a sad birthday party if they can't get the party balloons filled up. But
they're not going to sell cars. There'll be no balloons at the car yards anymore.
No, that's right. I don't know what they'll do about that. But helium, for example, these are some of the things we're not thinking about. It has important uses in medical technology and semiconductors as well. The things that are powering the AI revolution. But day to day, the one thing that's having the biggest impact is that blockage that's occurring with oil and gas, and a big chunk of the oil and gas from the Middle East not being able to find its way into global markets.
So I'll open up this to the whole room. So with the global headlines being, I think a lot of it's quite realistic, but a lot of it, as you say, is quite sensational. And I think there's a big part of that to play. But what happens is then so many people feel the need that they need to react, And obviously this kind of conflict that's occurring, it affects confidence and household costs and markets. Like, how do we manage that in the space that we're in? Like, what does that look like, and what kind of things are you hearing?
Well, we can tell about from a client point of view. Like Dean and I would be getting phone calls every day from the clients about it.
Yeah.
Because just that headline action, right, that just creates so much uncertainty that people don't know how to react. And if they don't know how to react, they want to do some action just to feel like they've done something about it. So even though we talk about, what's our long-term strategy, what's our goal, why are we doing what we're doing?
Yeah.
It creates a lot of scare in people.
Yeah, exactly. And urgency is not the same as clarity, right?
Correct.
And, some people are making decisions without getting that clarity.
Yeah. Look, I think back onto that as well, I think people, from what I've tend to see as well, is they're seeing, whether it be their super investment structures, they see them clawing back a bit, so due to the market change.
Yeah.
And I think it's been this massive misconception because of what happened previously during the whole GFC, right? Where it's created this stigma within the market to say, okay, well, look, markets have pulled back so much as they have in the past. Is this going to happen again? and everyone's just trying to jump up and say, okay, well, look, what can we do now to make sure we don't get in that position? But the funny thing is, and I always use this with all my clients, is I usually use this chart to show what the market's done over the last 30, 35 years to say, okay, well, look, we've passed COVID, we've passed through the GFC, but what's happened? If we look at it overall from the overall trajectory, it's bounced back.
Yeah, absolutely. And look, I think there's two parts to that. One is, I would imagine as investment managers, as planners, when you're working out the trajectory of growth of anything, you factor a correction, and it could be for all different reasons, right? Whether it be market conflict or just an automatic correction. But then I would add that layer, and again, I'm no economist, I'm no planner, I'm just a normal, mum and wife. But when I think about the GFC and when I think about COVID, I think as a country and as a nation, we got through it quite well. So, you would almost think that history would give people a little bit of confidence, but I feel that it's at an all-time fear factor. And how do we mitigate that? How do we get rid of that?
I feel like there's got to be with uncertainty, that's what I tell my clients, there's got to be context behind it.
Yeah.
Again, why are we doing what we're doing? When we do the fact-finding process with the client, right, we understand and we go through the whole process of understanding what risk are they comfortable with investing the funds. And every risk profile, if you will, comes with a suggested time frame. If you're going to go a growth profile, you're going to be 6-7 years, you've got to be comfortable investing that money in there. So that's the thing that we talk to the client. And when I get these phone calls, that's what I talk to them about. Yeah. We went in there with that time frame in mind. Unless something else has changed dramatically, then we need to test and adjust. Otherwise, I think again, depends on the client scenario, client objective and all that. So.
Yeah, absolutely. I guess I would lean to you, if I could, David, is sort of circling back to what you were talking about earlier with markets and the changes and all the bits that are going on with the conflict outside of the obvious statement. But why is oil such an important part of the conversation?
Well, we've done a lot in Australia over the last decade to diversify our energy mix, right? There's a lot more renewables in the grid. The solar and wind, more people are driving electric vehicles or hybrid vehicles.
Me, I'm electric. I'm laughing at all of
you
lining up at the petrol station.
Don't boast too much, please.
Well, you're all making fun of me this time last year, if I recollect. You're all making fun of me.
What's your electricity bill like these days?
My electricity bill is perfectly fine.
Okay.
But she's also got solar at home.
But the fact is, despite these investments that have been made, around 80% of Australia's energy use is still from fossil fuels. So coal, natural gas and oil, it's what powers our economy.
Yeah.
So when the price of fuel goes up, we talk about what the first order effects are, right? So we've seen it already at the petrol pump. If you're a farmer, you've probably noticed what's happened to fertilizer prices because they're a direct derivative of natural gas. We talked about helium. Maybe we haven't seen the helium price go up just yet. But then what happens is because oil and energy are such key inputs to all part of the economy, it's what's driving the trucks that's delivering
Yeah, well, there's a big
delivering
write-up
the
in the paper
food
today about, truck drivers not being able to afford to drive their trucks or moving to electric.
Yeah, plastics, anything made out of plastic, that's impacted by the oil price as well. So if you're building a house and the piping's going in, the prices of plastic pipes has gone up about 30% already.
Wow.
So it feeds all the way through the economy. And what economists will be really worried about is what we call a price spiral. So the oil price goes up, the things we use oil for, the price of that goes up, and then all of a sudden people are noticing their cost of living increase. So they're going to their boss and saying, I need a raise, I need more money because I can't afford my basics anymore. And that keeps feeding in on itself. And that's how the inflation comes through, not just because of the petrol prices, but because everything that it goes into as well.
And is that why markets move before the economic factors have actually hit a crisis point start happening?
Absolutely. So markets are always forward-looking. They don't always get it right. In fact, they'll frequently get it wrong. But the idea is anytime you're valuing a stock or any sort of investment, you're thinking about the future cash flows or capital gains that you can get from that investment, right? You're not thinking about the past. That might give you a bit of a guide as to what's happened. But when you're valuing it, you're thinking about what can I get out of it in the future. So when something changes and people change their mind about either the income or the amount of risk that they're experiencing at the moment, those changes happen really, really fast.
Absolutely. And, and I think about all of this, and this is all in the immediate moment, but a lot of our clients are long-term investors, long-term plan. So what would be the conversation? Obviously we've touched on it already, but how do we get people to understand this volatility in the moment, whilst it needs to be monitored, considered, is it necessarily something to react to right now?
I know I've expressed this already, but one thing that I've noticed more than anything is people are visual. Right now, the fact that people are visual, being able to actually show them data, being able to show to them, hey, this is what the market's done, I find that it gives people a little bit of ease to say, okay, well, look, we've weathered these storms in the past, and there's nothing that's going to change us to say that we can't do that again. Right. So a lot of the time, that does help give them peace of mind. And then obviously, I just pretty much working with my clients as well to say to them, look, I'm here. At the end of the day, I want you to get the best possible outcome as we can. And you've got me here alongside helping you. And if I'm not worried, you shouldn't be too worried. If I start panicking, that's when you should be worried.
Yeah.
Now, look, I don't think we can emphasize that enough, right? Because it's one, I think we're probably talking about the same chart. It's one of my favorite ones as well. And maybe we can even flash it up on the screen. But you look at what's happened in the world in the last 100 years, right? So let's go back to the 1920s and think about what's happened since then. We've had the Great Depression, we've had the Second World War, we had the Korean, Vietnam, Cold War, we had the 87 stock market crash. You get the picture, right? We had the dot-com bust, we had the global financial crisis, we had COVID. And through all of those events, markets have just kept doing this. And these big events that seemed like they were cataclysmic and world-changing at the time, even if they did change the world, markets always keep marching higher.
Yeah.
They keep marching through. And if you talk about those sorts of timeframes that your clients are probably thinking of in terms of, decades and not weeks, it's a great way to keep that perspective. I completely agree.
Well, that's what you got to make the client understand, that volatility is not a loss. It's just market movement. But it does affect client, especially if they're in retirement, because if they're already drawing money out of their account and the balance is dropping at the same time, then it sort of has an effect on the balance. So we also got to acknowledge that when we're sitting down with the client.
People are at different stages of life, and there is some people that this immediate moment can have an impact on. Absolutely. And I guess that's where it comes to having good planners. Thank God we're surrounded by them who know how to manage that. Yeah.
And that's the conversation with the client. That's the trade-off then comes in. Like how do we mitigate this? Do we take on a loss? If the client's really adamant that they do want to move, then we got to have that conversation.
Yeah.
It's just informed, educated discussion, and that's the way forward.
Yeah. And I think you mentioned it before, David, and you did it quite well, whereas, we've been quite good in balancing the areas that we use in natural resources and oil and bits and pieces. But I guess, what I've learned over time is that everything that we do in a world now is connected as countries, between import, export, all of that kind of thing.
Correct.
So, what this means for Australians is what? Like, it's a real life thing. Like, how do we then, get people to not be unsettled by these events, understand that this stuff, as we've already said, is showing up every day or every period of time in our lifestyle. And outside of fuel and transport costs, those spending pressures that are coming up, what are those conversations looking like?
It's very much, the clients do worry because it's their money at the end of the day, and that's probably the behavioral part of it where we compound the losses more than the gain.
Yes.
Like there's a research on it where even if a 10% gain doesn't feel as much as a 10% loss.
Well, to be precise on that, I've seen those same studies on loss aversion, and we feel the loss is about twice as much as we feel the gains, right? So, a 10% loss, you need a 20% gain to feel or have the same emotional impact.
Response,
And I feel like there's different genres to categorize this on. So you've got your clients, you've got your business owners, you've got your investors, and you've got your retirees, and all of them have a different feeling and emotion. I think underlying would be the same for all of them, right? But they'd all have a very different emotion or a reaction to this kind of the era that we're in and the conflict that's happening. Would you agree?
Yeah, look, 100%. Look, just to build onto that as well, I think one of the things that we do with clients is we obviously want to make sure we plan for tomorrow,
Yeah.
right? And we're always planning for worst case scenario, so that in the event that anything like this is to occur, then we've got some protection mechanisms and we've got some plans in place to try and mitigate against it.
Yeah.
Where potentially issues could arise is when this risk mitigation component hasn't occurred, and then clients start to react, right? And there's been so many studies, and if you go back, and I'm never going to forget this, but during the whole GFC side of things, people panicked. Like, they really panicked. And the sad thing is, like, I've seen the back of a couple of these clients where they've panicked during the GFC time. They've went and sold out the whole investments, put everything into cash. So at that stage, they've actually crystallized a loss, right? And then because they've been so scared to enter the market's bounced back and it's grown tenfolds. But then now they've locked, not only have they locked the loss, but they locked their return. They're not, their money's not even had given an opportunity.
It doesn't
to
have the
back.
growth that the
Correct.
market's had.
Now,
And then
have you seen some of those studies before that talk about if you stayed fully invested, this is what your return would be. If you missed the best, 10 or 20 days in the market over the same period, this is what your return would be, and it's a lot lower.
Yeah.
When most of those really big
It's the
days
things
happen.
that people commonly get
It's
wrong,
not.
right?
It's not when those big up days don't happen when things are going well.
Correct.
They tend to happen after we've had a bit of a bad patch and things have done that, and the rebound out of them is often very, very sharp. So you're dead right that people
100%.
often sell at exactly the wrong time when it feels the worst.
David, I wanted to pick your brain on this,
Yeah.
please, if I can.
Ooh.
Sorry, I'm going to take your
don't
spot.
say sorry. I love it. Go.
How is it that, I think I know the answer, but I want to reconfirm it. But how is it that the Russian-Ukraine war didn't have as much effect on the market as this? And it's not even a war, it's a blockade,
Great
it's all that, but this is just putting the whole global economy into recession.
Well, over the short term, there were some pretty big impacts. Remember, the oil price did go up a lot when that happened. Wheat prices went up as well too, because the Black Sea is a big wheat growing region. But one thing that sort of helped mitigate it was impacting Europe and their supply of gas that was coming through. It wasn't having such a big impact on the global oil markets. So that's where the big shock's been to the global economy this time, because oil is so important and we're taking so much out of it if we lose access to the Strait of Hormuz. That's why this one will have a bigger global impact than what happened with Russia and Ukraine. That's the key difference.
Yeah, I thought so. But it's only 20% though. So should it have that? Should it put us into recession?
20% is a lot to lose.
Yeah.
Because you sort of think, well, where can people cut their usage? And it is very hard to cut your usage in the short term. I mean, there are small things that we can do. I mean, anecdotally, people are driving less. I was down in Melbourne last week and they've made public transport free, and public transport is now absolutely chock-a-block down there because people are trying to save money. Driving here today, I knew that I noticed a lot of people driving about 10 or 15 Ks below the speed limit to try and conserve a bit of fuel as well, I think. So everyone can do these things around the edges, but you've still got to keep industry running. You've got to keep transport running. You've got to keep places heated. So it's really hard to cut back. So that means that the price goes up to try and incentivize people to use less of it. It's not easy just to
Because you can't
cut
just then
back
get
your
that
usage.
store from somewhere else and go, okay,
You can't.
I got 80% from somewhere else now, but I can increase that to whatever, because they've already got dispersion everywhere else.
It's really hard over the short term, and there are some supplies that we can tap into, that strategic reserves that governments put aside, but it's not enough to fill the hole.
Okay. So what do you think people most commonly get wrong? So we spoke about, crystallizing, things like that. What else do we think that can happen? Obviously, there's the panic selling after sharp headlines. You've mentioned that. What about portfolio changes without context?
I'll just quickly add something. Look, with investors, I think when the markets are pulling back as they are now, a lot of people are running and they're scared.
Yeah.
But the fact of the reality is it's actually an area of opportunity, right? Because now you're finding a lot of these investment stocks, they're actually on sale, right? You actually be able to enter into the market when it's actually at a lower point, so you can potentially, there's more for you to potentially gain more long term.
Women should be buying, and I shouldn't be stereotyping, it's very bad of me, especially as a woman, but we love a sale. So, okay, I want to know what stocks are on sale. I'm buying up. Let's go.
Well, I'm glad we can talk about something cheery here, because even though it has had a big impact on global markets, it means that valuations are looking more reasonable across some asset classes. Technology stocks, for example, they were looking expensive for a very long time, and they've pulled back to more reasonable levels now. So absolutely, when you do get these dislocations in the market, I mean, you should be asking yourself two questions. It's like, do I need to adjust, the way I'm looking at my risk, and often the answer is no after a pullback. But then the other question, and the one that's probably going to make you more money, is, have things been overdone? Are there actually opportunities to come in and buy things a bit cheaper now than I could a couple of weeks ago?
This is a great time to become one.
Exactly. Yeah. Well, as you said, if something that was a stock that was priced at $100 a month ago is trading for $85 or $90 now, it might very well be worth a look.
You've really got to pull the layer off, don't you? And look at how much is the sentiment and how much is the actual, the market impact, and it's the discount in there. That's really important this time of the market. Yeah. Especially COVID time. A lot of people went into the market, didn't they? Because the market went down, and I know everyone I was speaking to, they'd be like, "Oh, what share should I buy? What am I going to do?" And there was a lot of buzz about it. It
was actually very interesting, that COVID period, because what we've seen in the past during pullbacks is what we talked about, that people get a bit nervous and they sell at the wrong time. But during COVID, because, a lot of people were staying at home, they were bored, they had a few extra dollars in their pocket from stimulus checks, retail traders got involved in the market during that dip, and they actually did quite well out of it. So hopefully one of the good things that came out of COVID was people learned a little bit about, how to react to market pullbacks, and it can often be quite profitable to step in and put your money to work when markets have come off.
Are we seeing much change in investors at the moment? I know markets have moved, obviously, but are we seeing a lot of reactive behaviour from investors currently?
Not too much, no.
Okay, that's positive.
Generally, there have been shifts in the composition of the market. So, energy stocks have done very well. Stocks that are more exposed to the consumer and consumer spending have maybe struggled a little bit more because people are tightening their belts. But, overall, just to put into perspective what's happened, the market fell around, not quite 10% from top to bottom when this conflict began. We're almost back to square now. So we've recovered most of the gains through that period.
Mm-hmm. What would you say is more damaging or creates more damage than the actual market movement itself?
It's how you react to it, really. Ricky made the very good point before that, you don't lose money from volatility. And the one caveat I'd put to that is you do if you sell.
Yes.
So if it goes down and you sell, that's when you crystallize a loss. If you hold on for the ride, the market looks like this. It bumps, but the trend over very long time periods is upwards. So you don't have to wear that little dip down if you hold. Time's your best friend in markets.
But there's always opportunity. Sorry, Mel. There's always opportunity, right? Because if you look at it from a tax point of view, and there's a share that you always wanted to get rid of because you haven't been able to make the return,
right?
It could be an opportunity to get rid of it. Take a loss that you can potentially offset against something else.
Okay, so again, in a negative, you could always find a positive if you want to look.
Correct.
But, you talk about, crystallising that loss, and you think about it from a home point of view. How often do we, if our home's gone down in value, whether it be through the GFC or COVID or whatever it might have been, people don't go, oh, my house has gone down in value, I'm going to sell. Yeah. They sit and hold because they know that statistically over time, it might not be today or tomorrow, but over time, that property will return and exceed that value.
Well, you know what the one difference is? How often do you check your property price?
I just guess.
Yeah, well, you're not looking at it every day. The issue with markets is that you can look at it every day, and you can look at it every minute of every day if you're so inclined as well.
Yeah.
So we do see every little up and down that happens in the market, and you might get a general sense of where your house price is going, but you're not picking up the newspaper or logging onto your CommSec account and seeing, gee, it's gone down, 0.5% today. I've lost $50,000. You're not wired to think that way. But when it comes to stocks, we are thinking that way.
Well, the media makes it look very complex, and it is complex. Like, I definitely don't want to downplay what's happening, but the media makes it look really complex, which I think is what raises, blood pressure and people's concerns. And I guess it's sort of like, how do we, in the roles that we're in, remove that complexity, give it very simple education so that people aren't alarmed or scared, or they know when to react or when to sit. How do you do that? Like, it's just such a big thing.
Once again, it comes down to education. Funny enough, before everything happened, if we look back and we look at what the market's been doing over the last 3-4 years, it's actually been quite strong.
Correct.
Right? So what I say to my clients personally is I say to them, look, the market's been really, really strong, which is great. But when the market's really, really strong, there could potentially be some downturns coming down, right? But that's okay. right? So even just having the conversations, preempting them to say, hey, look, we want, hopefully the market continues to stay as strong as it is. But if it does take a bit of a dip or a downturn, it's expected.
Yeah.
So then it doesn't come as a shock to them.
Yeah. So the issue is not concern or,
Education.
Yeah, but it's also making decisions without perspective or education, right? Without that clarity. Okay. I love that. Cool. What should people be reviewing instead?
The overall plan structures, I guess. Once again, Ricky mentioned that as well. I think we're still focusing on the end goal, right? So yes, at the end of the day, there may be potentially some form of market volatility within the interim, but at the end of the day, we still got to keep our eye on the prize and what we're trying to achieve more long term.
Yeah.
And look, if there are little bits and pieces that potentially need to be changed at that stage, then obviously things can be done along the way. And I think as well, like we haven't really touched upon it as well, but I think a lot of households are feeling a bit of a pinch between rising petrol prices, increasing rates. A lot of people's actual surplus cash flow or money that they used to be able to save is starting to be tightened, right?
Yeah, I think all of us are still mind blown that RBA increased the interest rates. It's meant to be balancing inflation. I think that's happened through the conflict. Like, it's still mind blowing.
It is potentially happen again. Couldn't
It
it?
There is
could.
talk
Yeah.
of
I
it,
mean,
right?
there's been a big shift in the markets, right? If you sort of take your mind back to about last August, the expectation was it would get three cuts from the RBA in the next 12 months. Inflation started to pick up before this Iranian conflict began, and we had one increase. And now with that baseline of inflation that we had beforehand, plus the added impacts that we've had from this oil shock, the expectation is now that there's still another one or two interest rate rises potentially to come from here.
But like, how does that make sense?
So the Reserve Bank they have two goals. They call it the dual mandate that they have, right? One job of the RBA is to try and achieve full employment, and the other is to achieve price stability. So that means that they want inflation to stay within their target band of 2 to 3% a year. That's one of their big two jobs. The RBA only has one tool pretty much, and it's a very blunt tool, and it's interest rates. So I know a lot of households are sitting there at the moment thinking, how is this fair that I'm getting, punched in the guts by petrol prices, and then
and
the RBA's joining in on the fight as well, and they're punching me in the guts as well with an interest rate rise. That's the only tool they have. They need to suck money out of the economy to keep inflation lower, and it's sadly the mortgage holders that are the mechanism to remove that money from the economy by and large.
So essentially, they just want people to stop spending money. Is that what they're trying
correct.
to do?
Correct. They need to take the heat out of demand, the heat out of prices, and the RBA does that by putting interest rates up and mortgage rates heading up alongside it.
There you go. So with all of that, cost of living, oil, interest rate rises, what does a measured response look like rather than being panicked?
I think it still goes back to that goal, the time horizon, right, that the client went in for. The previous example I gave about retirees, and we also, when we're looking at their plan, we might even stress test. Like we might allocate some of the money to the cash bucket already. So then that doesn't mean that they need to sell out of the investments, which means they've got a certain amount of money allocated to cash. They might have 1 year or 1.5, 2 years worth of pension payment or the payment they need to live on allocated within their account, and which means the rest of the money doesn't need to be sold or sell at a loss. Crystallize, the word that we use. We don't have to do that because we've still got a bit of a buffer available within the portfolio.
Yeah. So like, what am I doing? Why am I doing it? And what is my desired outcome over what period of time?
Over what period of time?
Yeah.
That's a very good way to summarize it.
Oh, thank you. Thank you. Do you see an advantage for our clients? We've got a lot of clients that go on ongoing service arrangements, and clients that have done their plans and strategies as set and forget. People, or not set and forget, that's not the right word, but they've just done it as a one-off and they're just, going on their way. Do you see a resurge in clients in this current market where, they ring you up and go, yep, I know I'm not in an ongoing agreement, but can we sit down and have a conversation? Like, I'm panicking.
Yeah, I've had a few of those conversations. But the other thing as well, it's funny enough, like I alluded to previously, I do educate my clients from the start to say to them, hey, look, this is, although yes, things are doing really, really well now, there can potentially be these market corrections over time. So a lot of them are doing fine. It's more or less where I'm seeing a lot of panic or more concern more than anything are those clients that are actually closer towards retirement, right? And they're the ones that tend to tend to obviously wanting to reach out and just pretty much wanting peace of mind. And I'm actually very grateful that they do that, because then at least they contact me before they go and make a mistake.
Yeah.
Right?
Okay.
So,
But is the analogy I use is like, we go to doctor every year to get our health checks done, don't we? Like, it's similar to that. It's about having that health check on your finances. Really, especially when the markets have been going up and down and what's happening, and just to make sense of it all.
Yeah.
I think otherwise, without the lack of knowledge, or you don't want to hear the influencers on TikTok giving you advice. I know ASIC's trying to cut down on it, but I don't think they can. But it just, you want to make sure you sit down and have a proper conversation with someone about it, so at least gives you peace of mind. You could decide something different, and the direction could be completely different at the end of it, but at least you're having that conversation.
Yeah.
And the doctor analogy is a great one there, I've got to say, because I don't know about you guys, but I don't look forward to my annual doctor visits because I know what I'm going to hear. Get your cholesterol down, drink less. But they're messages that I need to hear. I need to be told that.
I've seen you with a beer, David. I've seen you with a beer.
Hopefully my doctor's not watching this, but yeah,
No,
I haven't. I need to hear it, but it's hard to act on that sometimes, and it's the same with financial advice. They can be difficult, complex discussions to have, but checking in on that regular basis once a year, just for that health check to make sure that everything's on track. You don't need to make any changes. Unlike me, if you've got a good advisor, they've put you in good stead, and you'll feel more comfortable just knowing that you're well positioned, you're on track for your goals. Don't worry about the headlines that are popping up. It's under control.
headlines sell.
Yeah. So I mean, how do you like dilute those headlines? That's the really hard part, isn't it?
Well, I think you have to get your head around the fact that most of it's just noise. So, I mean, perfect example, I'm watching the markets all day long. I'm reading all the headlines, seeing the data, looking at the geopolitical events, watching all the prices. But, I mean, do you know how often I adjust my allocations in my superannuation? Like every 1 or 2 years.
Yeah, wow.
I know it's not worth my time to go in and start fiddling and making these tiny changes or reacting because the market will move faster than I can.
Yeah.
I'm doing the same thing as your clients. Once a year or once every 2 years, going in, doing that health check, away we go.
That's so true, then, David. Like every market reaction doesn't need an action as a result of it. Do you know what I mean? We really need to, I think we alluded to the fact before, those headlines sell, right? So media companies also they need a clickbait. So people click on it and they've got their role to play. Yes, they need to
the roll-on effect for them is not as dramatic, is it, right? It's just still sales.
That's right.
Correct.
So it could, just the message comes down to is, pause and really think before you act on it.
Yeah. Okay. So I made some notes here. I was listening to all the things that you guys were saying, and I don't normally make notes, but these are the things that I've taken away about what not to do, and I'm definitely open to you guys correcting me or elaborating on them. So do not act off headlines. Yeah. Do not assume every market move requires a portfolio adjustment. Do not mistake urgency for wisdom, which I think wisdom is a big thing, right? It's hard to get. Do not let fear set your strategy or your lifestyle. Do not focus only on investments while ignoring your household cash flow exposure. Because if they're not connected, they're not connected. And if they are connected, you could be fine. And do not abandon your long-term plan for a short-term sentiment that's panic right now. What do you guys, did I summarize, are we good with this?
Very good.
Have I left anything out of what not to do? Don't sell your home. Don't sell your stocks. Don't sell your shares. And what I'm hearing as well is buy some tech stock.
Again, not advice,
No.
but
Not advice.
an observation that they look a lot cheaper than they did.
Well, what I am
a little while
hearing is
ago.
if you're not an investor at the moment, it's probably a great time to get a planner. Look at what an investment portfolio could look like and what your opportunity is. So in a time where there is a lot of negativity, a lot of fear, there are a lot of opportunities and positives that can come out of it.
Definitely.
Tax positioning, tax optimization, all of that kind of stuff. But if someone's feeling, I guess, circling back to the people who are feeling uneasy right now and are not the optimists in the room like I am, what should they focus on first? So what is the takeaway for investors and households in a period like this? So, each of you, if you could just come up with something, that'd be great.
Before reacting at all, speak to a professional.
Yeah?
Yeah, because then sometimes once you've made a decision, it could be very, very hard or close to impossible to try and reverse it if you've done any mistakes, which could potentially cost you thousands and thousands, or potentially hundreds of thousands. Depends on the situation.
Yeah. Okay. All right. Good. Done. Who wants to go next, Ricky or David? I reckon we'll let Ricky go next because I reckon David will have a wealth of information on this one.
You'll have some good
That's
pearls.
a lot of pressure on me now.
No,
Mel,
it's
but
you are like, when I think of super brain, I have to admit, I do think of you. So I'm excited.
very kind.
Well, I would sort of recap on what we've covered. It's all about objective, time frame. Disruption's normal.
Yeah.
But panic is optional. So panic's on us, how we react to it. Disruption is part of the market. We go into the market knowing it will go up and down.
Absolutely. Okay.
It's a good one.
All right. That's the shortest statement I've ever heard you make.
Oh, because David was, I'm waiting to listen to his pearls.
No, well, we still want your wisdom as well. I know you've got more in there.
Certainly. I'll follow it up with David.
Oh, okay. All right. Okay.
Look, I'll just say we've been here before. We've got through this before.
Deja vu.
Very similar situations. I don't like volatility. It bothers me as much as the next person. When markets drop, I have that sinking feeling in my stomach as well, but I've seen it so many times now on a daily, weekly, monthly basis that if you see it all the time, you get used to it. So that's a message that I'd leave with people today, that it's not the first time we've had volatility. Dips like this, 3 to 6 months, we often end up right back where we were, and that's actually what's happened in this drawdown here. We'll see similar ones in the future, and we might even get some bigger ones in the future as well. It's almost inevitable that we do get these big pullback in markets. But we talked about all the events we've seen over the last century, but through that whole period, the markets have given us about 10% a year for the Australian stock market.
Yeah.
And you look at how that compounds up, having it at 10% a year instead of 4% a year sitting in cash, and it makes a massive difference to people's retirements if you're looking at that over a 10 or 20 or a 30-year period. So that's my key message, that it doesn't feel good. I don't like it. I'm not saying, you shouldn't feel bad about it. You can absolutely feel bad about it, but just recognize that reacting and selling is not the best way to deal with it.
Yeah, absolutely. Absolutely.
It's something that you can't avoid, really, David, can you? Like, you've got exposure, even if you go, yes, I don't have all my money's in cash, but, your super fund still invests in shares. People have got that exposure to the market.
Absolutely.
And I hear you say, and I was, sorry, forgive me, I was smiling while you were talking and there was nothing, exciting about what you were saying, but you were saying how you don't like volatility. And if for anyone that knows you, because obviously people will meet you today through the camera, but anyone that knows you, you're just such a calm, you've got this gentle aura about you. So when you say you don't like volatility, it almost just like it resonates with who you are as a person, not just professionally, when I hear you say that.
Yeah, I get just as worried as anyone that's listening to this today when the markets drop, but you learn after a while just to control that emotion. You don't want to do something rash in the heat of the moment. People will want to sell to make the pain go away. It's almost like a fight or flight, lizard brain response. But the best thing you can do is you can feel that emotion. You don't have to ignore it, but just think carefully before you act on it.
Be measured.
Yes, absolutely.
And can I ask you, and I know that we're not allowed to give advice, but obviously you watch the markets, you monitor everything that's happening. Do you have any predictions, number one, and number two, if you do, can you share your thoughts on where we're at and the time frame of what we think might be occurring, or what are the moving factors that might occur in it?
Yeah, look, people do overreact to geopolitical events. It always happens, and the bounce backs can be quite quick, and that's what we've seen already through this cycle. But there will be some flow-on effects to the Australian economy. Inflation will go up, interest rates will go up, and we could end up in a bit of a softer patch for growth. So what we're doing behind the scenes at Ascalon is we've actually taken a slightly more conservative position in our portfolios at the moment. And to be really clear, does that mean that we've sold all of our stocks and we're hiding in cash? Absolutely not. But around the edges, we've made some more changes to just have us a little bit more defensively positioned at the moment. So if we do end up going through a bit of a tough growth patch, that we have a bit of ammunition there that we can deploy if prices drop a lot or the economic situation starts looking better. We can take some out of that and we put it back into the growth assets. Mm-hmm. But we're talking about very small changes, maybe a few percent of the portfolio. It's not about panicking, running for the hills and put it all under the mattress. It's just making little tweaks to try and squeeze out a little bit more.
Yeah. Do you think you see any resolution on the nearer horizon, or do you think it's a bit further away than we initially anticipated?
Well, everything...
And can you answer that first and foremost?
I can attempt to, but I'll almost certainly be wrong. Everything in the market has a 4-letter acronym these days, all right? We had, during the GFC, we had the YOLO trades. So people were just punting their spare money into highly speculative stocks. We had the FOMO trade after that. So people saw how markets were running and they were piling it in for fear of missing out. After that, we had the taco trade, the Trump always chickens out trade. And we've seen a repeat of this one this time where Trump will make some big policy announcement, and last year it was about the tariffs when he had his famous board in front of him with, the tariff rates for all the different countries that he backed away from within days and weeks. And that looks like it is in the process of playing out in Iran at the moment, where he threatened to bomb them to the Stone Age. You remember some of the inflammatory tweets that were coming out at the time. Yeah. And days later he said, ceasefire, let's try and make a deal. Yeah. So it's my hope for the markets, and I guess for Australians and the world more generally, that this does get resolved fairly quickly. But all you can do, it's hard to predict it, right? Yeah. But what you can do is you can compare scenarios. And that's what we do when we're thinking about things as well. I mean, you'd be mad if you tried to think about what Trump would do next. Yeah. But we war game, it's probably not the best choice of words there, but we'll construct a few different scenarios for when it happens. So when we're talking about Iran,
different game plans.
Yeah, we're looking at what if it's over quickly, what if it takes a little bit longer and spreads regionally, and what if it turns into a really, really big problem and the oil supply is disrupted for months and months. So when we see that start to happen, we can make our adjustments accordingly and we're prepared. Yeah, absolutely. And thank you for that. So, this is such a big hot topic at the moment, and it's such a real topic that's impacting whether you're an investor, whether you're a renter, whether you're young, whether you're a business. It impacts everybody because everybody needs petrol. Or if you're not needing petrol, you're needing your goods to be delivered, which requires petrol. So there's a big impact. But I think what we're learning about today, it's about not trying to predict that every market move requires reacting to in that immediate moment, not listening to every headline, and understanding what really matters and reviewing what is relevant. Yeah. So short-term fear doesn't overtake those long-term financial decision makes.
Absolutely. Follow the strategy that you have in place.
Follow the strategy. Yeah. And to our clients, if you're unsure, just reach out.
Absolutely.
Send an email, make a phone call, whatever. But David, as always, I could talk to you forever about markets, geopolitical, all of the bits. Thank you so much for coming in.
I look forward to the invitation to the next one then.
You will be back for sure.
Great.
And that's it for today. So thank you so much, guys. It's been fun.
Thank you.
Thanks, Mel. Thanks, David.
Thanks.
Thank you for joining us on the Wealth Guide podcast. What was our takeaway for today? It's not about trying to predict every market move or reacting to the headlines that we're seeing in today's environment. It's understanding what matters, reviewing what's relevant, and making sure short-term fear is not overtaking your long-term financial decision-making. Stay tuned for our next episode of the Wealth Guide podcast, where we're going to talk about what people get wrong about financial advice and what good advice could actually feel like.